Hello everyone and welcome to today's Cost Intelligence Seminar, How to Accurately Allocate Costs for Intelligent Decision Making. I am your host Ivan French from Sixtina Solutions. Keep in mind that a recorded version of this webinar will be sent to your email box after the event. Please use the chat box to send us your questions during the seminar. We will be answering them along the presentation and at the end. Today, we will learn and discuss how common decision-making problems that executives, managers, and accountants have are strictly related to the accuracy, detail, and timely delivery of financial data and costing data. In that line, I would like to introduce our speaker and my friend Gary Cokins, founder of analytics-based performance management. Gary is an internationally recognized expert, speaker, and author in enterprise and corporate performance management improvement methods and business analytics. Gary received a bachelor's degree with honors in industrial engineering and operations research from Cornell University in 1971. He received his MBA with honors from Northwestern University's Kellogg School of Management in 1974. Gary's career is filled with achievements, recognition, and research. He began his career as strategic planner and then served as financial controller and operations manager. In 1981, Gary began his management consulting career first with Deloitte Consulting and then in 1988 with KPMG Consulting. In 1992, Gary headed the National Cost Management Consulting Services for Electronic Data System, EDS, now part of HP. From 1997 until 2013, Gary was a principal consultant with SAS, a leading provider of business analytics software. He has written many books and white papers that have received peer approval and recognition. I myself have read them all. Now, without further ado, we will turn the screen to Gary. Gary?
Thank you, Ivan. I hope the acoustics is coming through clear. Appreciate the introduction. I just want to share with the attendees that I think careers have more to do with luck and circumstances than being smart and competent. And I've had a couple of lucky career breaks, but one was in 1988, as Ivan mentioned. KPMG established an exclusive contractual relationship with Professor Robert S. Kaplan of the Harvard Business School. And some of you will recognize his name from the balanced scorecard and strategy map. But he did the early pioneering work in activity-based costing. And so he was contracted by KPMG to train just a few consultants, and I was recruited from Deloitte. So it was a lucky break. For 5 years, I did nothing but implement activity-based costing. And that led to writing a book, and there was more books. And then the third book that you see here is one that we will refer through this webinar. So let's get going. Who will benefit from this presentation? Managers who have previously struggled at promoting strategic cost management using activity-based costing principles, financial planning and analysis, commonly called FP&A, and integrating business analytics into their decision support systems. Managers who intend to champion any or all of these improvement techniques and need a compelling call to action. And the reason I have champion in quotation marks is because it's my observation that although it's nice to have executive team sponsorship for new initiatives, often they at the top are preoccupied with firefighting or short-term priorities. And it's often managers that are 1, 2, 3 levels down from the C-suite who basically kind of have passion, fire in the belly, ask themselves, how long do we want to perpetuate using old or archaic or stale methods? And they're the ones that will do sort of a proof of concept or a pilot project to demonstrate to their colleagues and their senior executives that this is the way to go. So I actually really enjoy presenting to lower level managers, not just executives. So what are some of the issues related to measuring costs? Here's a few questions. Are our products and service lines cost accurate? Do we properly allocate, you'll know why later why I put allocate in quotation marks, our indirect expenses, commonly called overhead, to calculate reasonably accurate product and service line costs based on causal relationships, cause and effect relationships, or do we do that peanut butter spread of the expenses with cost allocation factors that The result is simultaneously over and under costing products and service lines, even though it reconciles in total. We'll talk about that during the webinar. Do we measure non-product channel and customer expenses, like distribution channels, selling, marketing, customer service expenses, to report a profit and loss statement by each customer? Do we know which customers are more attractive to retain, to grow, to win back, or acquire? But here's some other questions related to budgeting and planning. That's really the future view. How effective is our annual budgeting process? Does its benefits to pull it all together exceed the administrative effort and cost to produce it? Is the budget out of date within a few months after it's published? Do the experienced managers know how to play games and pad their department budgets with excess spending? Is consolidating the cost center budget spreadsheets from bottom up using spreadsheets, cumbersome? Do we understand incremental and marginal expense analysis, where we have to classify the behavior of resource capacity expenses as sunk, fixed, step fixed, or variable based on the planning time horizon? Remember, I'm an industrial engineer by education. I always tell the accountants you need to think like an engineer. So my agenda, I'm first going to describe and define what activity-based costing is all about. Then we'll talk about just calculating product and service line profitability. Then there'll be some challenges. How do you implement this successfully? And there's a technique called rapid prototyping, which I really recommend. Then we'll go below the product gross profit margin line about calculating channel and customer profitability. Then we'll look from the historical view backwards towards the future view forward, predictive accounting, and not just budgeting, but driver-based rolling financial forecasts. And at the end, I'm going to talk about my frustration. Why is it taking so long for organizations to adopt activity-based costing and advanced techniques? So I want to start with a diagram, a taxonomy diagram I created for an organization called IFAC, International Federation of Accountants. They're like the United Nations of professional institutes, maybe 180 globally. And so you see like in biology, animal kingdom, plant kingdom, you see the three kingdoms of accounting: tax accounting, financial accounting, and financial accounting. But at the top is really the big world accounting. The inputs are always going to be source data, transactions, and non-financial. And I'm going to just basically pull this thing out. You will always calculate costs from expenses. That's under the managerial accounting. When we go to the left, where it's got GAAP rules, generally accepted accounting principle rules, that's for the external financial accounting for compliance with regulatory agencies. For management accounting, we have the historical view, the box that says cost reporting and analysis, spending and variance analysis, profitability reporting, other uses such as process analysis, value stream maps, and the like. And then the predictive view, which is decision support and cost planning. You'll notice at the bottom, I've got low value at the end, at the left, modest value in the middle, high value to the right. The value of accounting grows as you go from left to right. So let's put some perspective here, a little bit of textbook. The highest direct costing is what any organization should basically aspire to. The highest form of direct costing is to the left, is project accounting. But that's typically when you make a satellite or a one-time order. The next is standard costing. That's very traditional. That's what most organizations with repetitive processes use. In manufacturing, you would have labor routings and timesheets. But make no mistake, the majority of organizations are service organizations. So this will apply to banks, insurance companies, travel agencies, airlines, and the like. Activity-based costing is sort of a poor person's standard costing system. It's easier to do, quite frankly. You don't need timesheets and the like. You don't need bills of material and routings. You'll notice at the right, though, allocations has a big X in it because it's not what you want to do, and I'll explain that in a few minutes. So what is activity-based costing? The simplest way to understand it is this funny example. Imagine you go to a restaurant with 3 other friends. You order a little salad, and the other 3 order the most expensive item on the menu and a glass of wine. And at the end of the meal, when the waiter or waitress brings the bill, the other 3 say, "Hey, let's split this check evenly." How do you feel? Not fair, not equitable. Well, in a general ledger cost accounting system, that's how the products and standard service lines also feel, because basically you are overcosting them. It's unfair and it's inequitable. So if you basically traced the expenses through the work activities that belong to the processes into the products and service lines, you will discover that some of the products are overcosted and some of them are going to be undercosted, because that peanut butter allocation spread using direct labor hours, number of units produced, number of employees, sales amount, none of those reflect the unique consumption that those products and service lines uniquely consume of those end-to-end processes and activities that belong to them. So if you trace it correctly, some of the products will be overcosted, some will be undercosted. Yes, it will reconcile in total, but that's good for the external audit, but it's flawed and misleading to the middle manager. So the definition of ABC, it's as if the waiter or waitress brings 4 individual checks. You only pay for what you paid, what you consume. Now, the problem actually begins with the left side diagram you're seeing here. The cost center responsibility center statement. Every manager on the planet Earth is familiar with this. But the problem is the data in that format is structurally deficient. It's a good report. So I like to say when managers get this report, they are either happy or sad, but they are rarely any smarter. What activity-based costing does is it makes them smarter, because we continue the journey to the middle diagram. The same 914,000 has been transformed into a different format, a different structure. Key scan claims, analyze claims. Notice this is the language of work. And notice I'm using the back office of an insurance company. It's a factory too. And then we reassign the same $914,000 activities into the products and services with what are called activity drivers, just like the waiter or waitress in the restaurant reassigning the work. So if we now rotate that diagram 90 degrees, it isn't as simple as taking the resource expenses into the work activities and then assigning them to the cost objects. The right side that you're looking at is more realistic, because you've got support departments that support other support departments that ultimately support the frontline departments that make products or interact with customers. So it needs to be a multi-stage cost assignment network. And I want to prepare your expectations. The next slide is complex, but you'll understand it after I describe it. It still has the 3 universal components of any organization's expense structure. The resource expenses at the top, the work activities in the middle that will pile up into what are called the final cost objects. Now you need to adjust your thinking. This is not a process flow chart end to end. It's a reassignment network. So if the organization said, let's say, spent $2 million in January, the top one, it will reassign it and trace it to the exact same $2 million of activities, and they will pile up at the bottom to the exact $2 million ultimately into the customer's box, and then something called business sustaining, which I'll describe in a second. It's a reassignment network. So in the activity module in the middle, notice you've got people activities and equipment activities. That's because men and women run machines, machines make products. Men and women drive buses, buses deliver passengers. So assets also do work. You'll also notice to the right, there are some activities that are not going to products, going directly to customers, things like customer service or making sales calls from the sales force. And at the bottom, we have what I kind of refer to as the predator food chain. You know, large mammals eat small mammals eat plants. We can reassign all of the traceable costs to the products, but then the products are consumed by the customers. And so we would use data like the sales register. What was the volume and mix that they bought? The message here is really costing is modeling. It's not T accounts and journal entries. The business sustaining box at the right is an important one. Not all expenses are caused by products and customers. Things like the legal department or when the accounting department closes the books. So what we do is we create cost objects there like senior management. They want to get the reports, or regulatory agencies. And so we basically put aside the business sustaining expenses. They're typically 10 to 15% of an organization's expenses. You still need to recover them to be profitable. They're just not traceable to products or customers. Now in your mind, reverse all the arrows the opposite direction. Imagine they're going from bottom to top. That's what's happening in any organization every minute, hour, day, week, month, year. The products and customers are placing demands on the workload. the workload's drawing on the expenses, the costs measure the effect in the opposite direction. It's a principle. Rules are many, but principles are few, like gravity or speed of light. And so we're basically following a universal principle of causality. Unfortunately, many CFOs and accountants violate that principle by peanut butter spreading those expenses. Direct costs, they're not broken. You may have a data integrity issue there, but that's a different story. What's much more important is, what does one see after you've calculated using ABC? And this graph is typically called the profit curve, often called the humpback whale curve, because it looks like a humpback whale. Then this is real data, as you could probably imagine. It's because it's a crummy looking diagram. The vertical axis is the net revenues minus the properly traced and calculated ABC costs. The horizontal axis is the cumulative buildup of the ABC, rank ordered from the most profitable product on the left to the next most profitable product, so on and so forth. As we move to the right, 3/4 of the way, you see we've got products that are at break even, and then there's the descending side. Those are unprofitable products. The last data point will always reconcile with the P&L. So in this particular organization quarter, they had 30 million in sales, 28 in expenses to net out at 2, and the last data point is the 2. It's always organization shock when a company sees this, when the managers see this. Because in this diagram, it said, look, you made roughly $8 million of unrealized profit on 3/4 of your most profitable products. You lost $6 million on the remainder to net out at 2. And their belief system is this blue line, which is like this little anthill with a hook on the end. And that's because all of that peanut butter spreading, broad averaging, was crushing and suppressing the costs, which is the blue line, and ABC was detecting all of the diversity and variation, the products, the services, using activity driver quantities to basically create the top line. The top line is the truth, the blue line is fiction. There's more here that meets the eye. If you looked at any of those data points on the right side, what's happening is each product is reaching up into the work activities and asking, how much of each of you did I uniquely consume? And it basically piles them up like pancakes, where the thickness of the pancake reflects the quantity of the driver times the unit level cost consumption rate. And so this gives not only more accuracy of the stack, but gives visibility and traceability to line managers so they actually know what's causing the costs. Here is a greater detail of the book that was in my bio. When you receive a PDF, I believe that Yvonne will be sending you these slides. You can click on the text there, or just go to wiley.com and you can see the book. So let's have one question before we move further. Yvonne, do you have a question that's come in?
Yes, Gary, thank you. I have a question from Luke. I can see the use for a company with a small amount of products, services, and activities. But for big companies, it can get very complex and take a lot of time and resources. What can be done about that?
Well, that's a good lead in actually to my next section, which is basically what is a more effective way to implement it so it doesn't seem to be this big barrier. Most organizations have this misconception that activity-based costing is complex. We'll have to triple the size of the accounting department. Every employee will have to fill out timesheets. There'll be 3,000 activities in it. Well, the IT department will have to figure out how to extract data to put it. All those are misconceptions. The solution is rapid prototyping. Let me just read this paragraph and then I'll describe it. Many believe that activity-based costing can be complex and that an organization needs to determine if the benefits are worth the effort. Many have this perception, but it is a misconception. I will next describe why this is a fallacy and how this problem can be resolved by right-sizing the ABC model to be good enough. One reason that many perceive ABC to be excessively complex is because in the 1990s, accountants and consultants way over-designed the ABC systems well beyond the point of diminishing returns of higher cost accuracy for the extra level of administrative effort to collect the data, calculate the data, validate the data, and report the cost information. The ABC models, as a consequence, were not understandable and so large that they collapsed under their own weight and they were unsustainable. Sometimes executives pulled the plug before the completion viewing it as another meaningless exercise by the bean counters. ABC rapid prototyping with iterative remodeling resolves this. ABC production systems can then be implemented in weeks and not months. So what am I describing here? Look at the model 0 at the left. That is done in a 2-day workshop. And incidentally, I am 69 and I'm partly retired, but this is a 2-day freelancing consulting exercise that I can do for Sixtina and others. We just bring 5 or 6 cross-functional employees into the room, quickly build a high-level model for a day and a half, and then in the afternoon, without really worrying about accuracy or detail, and in the afternoon of the second day, bring in the line managers who are peers and the executives, and the 5 or 6 people show them what they built, and it's very engaging because they're designing it for their own company. And with the executives, the light bulbs go on. Oh, that's how it works. How did you do that in so quick time? And so forth. And what happens is you start getting buy-in, and they start realizing some of the rules in allocations. Everything normalizes to 100%. Then you take a week or so with Model 1 and go a little bit deeper, individually interview some of the managers in the various departments, and so on and so forth. And within just a few weeks, you get the pyramid, a permanent, repeatable production system. Make your mistakes early and often, not later when the system is too hard to change. So it's what I call crawl, walk, run, fly. Start with a crawl. And the reason rapid prototyping works has to do with this diagram, this slide. It's about the level of accuracy that you need. The vertical axis is the accuracy of, let's say, a product lines. The horizontal axis is the level of administrative effort to collect the data, validate it, calculate it, and so forth. You will always get an asymptotic curve where the line goes up very quickly and then levels off, getting diminishing returns on extra accuracy with the extra level of effort of work. But notice in this example that I've got 2 project teams, A and B. B took more effort and had less accuracy. A had higher accuracy with less effort. What did A know? They must have known some rules about design. And the question is, look at that thick black line. The slope goes up real quickly. What is the determinant? What influences the slope to go up so quickly? And this is counterintuitive to most people. The answer is, it's that multi-stage cost assignment network, that piping diagram that I showed you 3 or 4 slides earlier. If you basically assign things to the right places, you're really getting most of the accuracy. And even though you may be using estimates, maybe they use 30, 30, 40, but it was really 28, 32, it doesn't matter because some of those overcosting and undercosting will offset other errors elsewhere. Call it error dampening. So the accuracy really comes from the model design, and that's why rapid prototype, you get to keep remodeling and remodeling till you get it right. And you stop at, let's say, 3 or 4 weeks. Good enough. It doesn't need to be 100% accuracy. This is management accounting, not external financial reporting. External financial reporting, you get the numbers wrong, you go to jail. Management accounting numbers, you get them wrong, you don't go to jail. So you didn't even know your accuracy in the first place. So what does rapid prototyping does? It accelerates learning. People understand how it works. It solves that thorny leveling problem. What level of detail do we need? How many activities? It just basically gets determined as you go. It prevents over-engineering the model so it's not so huge it collapses. You get peer group to predetermine the uses of the information. Yes, at the end of that second afternoon, you go around the room and say, imagine we're 3 or 4 weeks from now with a permanent production system. What decisions will you use it for? One will say profit margin analysis. Is our pricing right? One will say benchmarking. They'll come up with ideas. So effectively, we're beginning to get buy-in for the use of the information. But now let's go below the product gross profit margin line. What's caused interest in ABC now is moving from being product-centric to customer-centric. The value of a company is a function of the value of its customers. The only value a company will ever create is the value that comes from its customers, the current ones and the new ones to be acquired in the future. To remain competitive, one must determine how to keep customers longer, grow them into bigger customers, make them more profitable, serve them more efficiently, and acquire relatively more profitable customers like your existing profitable customers. But we've got a problem. Most CFOs and accountants don't measure customer profitability below the product gross profit margin line. So no one really knows. So here's the issue. Products and standard service lines are not the only thing for which accountants should compute costs for. What about all the costs that have nothing to do with making products and delivering standard service lines? The problem with traditional accounting's product gross profit margin reporting is you don't see the bottom half of the picture, the channel distribution, the selling, the marketing. And I'm going to make a case that the bottom half of a P&L is more important than the top half. And visually, what I'm describing is if the entire rectangle you see here is the entire expenses, let's say, millions of dollars for January, the accountants are only calculating costs for the shaded area. And it would be nice if those indirect expenses were included using ABC principles rather than the overcosting and undercosting. But what about when we bring in the distribution, the sales and the marketing, the channel, and then all of the customer service? That white space is more important than the shaded space. And here's why, 4 reasons. First reason, customer retention versus acquisition costs. It is much more expensive to acquire a new customer than to retain an existing one. That's a no-brainer because your existing customers, you already acquired them, and so they're a sunk cost. When you get into decision theory, you do not pay attention to costs that have took place in the past. Sources of competitive advantage. Commoditization leading to service differentiation. What do I mean? I believe today that customers now view all customers basically as commodities. They sell all the similar things. Banks have the same type of depository accounts, insurance companies, and so forth. Therefore, for a supplier to be competitive, they need to provide differentiated services to different types of customers. Problem, the accountants are not giving visibility to what those things cost. 3, from mass selling to one-to-one customer relationships. It's no longer about have research and development, create new products, and have the sales force go shove it out to the customers. You need to work backwards, knowing the unique preferences and traits and characteristics of customers, and tailor the offers, the deals, the coupons, the pricing discounts to the individual customers. And finally, the internet's irreversible shift of power from sellers to buyers. This is a one-time event happening in our lifetime. The internet is really giving buyers much more power. And I don't just mean you and your household with your family buying things on the internet. Today, purchasing agents in a company can, with a click of a mouse, can see 30 suppliers and all of their prices and so forth. And so the point is, we really need to look much more at the customer view. But then we've got this problem, angel customers and demon customers. What do we mean by this? It's sales volume is no longer an indicator of profits because you've got high demanding customers and low demanding customers. So examples of high demanding customers, always changing schedule, never buying standard, always special, always calling help desk, always returning goods. Low demanding customers, you love them. Only buy standard, never shift schedule, never call help desk, never return goods. If those two types of customers had the same volume, same mix, same price, they're not equally profitable because the high demanding ones are causing a lot more work and they're reducing your costs. But what really caught my attention about this book, and incidentally, this book is by marketing people, so don't buy it. It doesn't have stuff about the accounting, but was the subtitle, Discover Which Type of Customer is Which and Turbocharge Your Stock Price. What we now need to realize is we need to connect customer value creation to shareholder wealth creation. But again, unfortunately, the accountants are stopping halfway. It's like a bridge that's only built halfway. You've got to complete the journey to get all the way to the other side. What ABC allows is to create a profit and loss statement like you're seeing for each customer. And the margins will be layered like an onion skin. So in this fictitious example of this company, they had a 30% composite product gross profit margin for the products and services. But between the 30 and the 8, 22 more points of margin are lost and eroded, have nothing to do with making the products and delivering services, but all channel and customer related. And so if you calculate this for every customer in these two broad swaths, you can basically get a graph that looks like this. The horizontal axis is the profitability of the customer, high and low. The horizontal axis is the sales volume. Notice at the very far right is the most profitable customer. But above that are a few other customers that had less sales, but we're more profitable. But at the bottom, you got customers with substantial sales that are unprofitable. So sales volume is not a proxy for profitability. We can take the exact same data points, which are now circles, and put them into this grid. The vertical axis is the product mix gross profit margin, the above the line. And the horizontal axis is the below the line, the angels to the left, low maintenance, to the high maintenance customers. And notice it's now things become obvious. The customers that are in the bottom right are unprofitable. The ones that are in the high upper left are the most profitable. That's because they're buying high profit margin mix and they're easy to serve. And now the name of the game is move the dots. And that's not going to be covered in this presentation, but at least now you've got the fact-based information for people to start thinking about, well, what actions can we take? Examples might be unbundling, start charging individual service fees for the individual extra work. The airlines have been doing it with baggage, the banks have been doing it with their different depository charges and so forth. You can do upselling and cross-selling. If the customer buys a set of golf clubs, can I sell them a golf shirt? They buy the golf shirt, can I sell them a second golf shirt at a discount? You could basically raise prices, but that's going to be difficult. In the far bottom right, you could fire the customer, terminate the relationship altogether, to say, we'll never be profitable the way this customer interacts with us. But that's tricky, because if you fire the customer, yes, the revenues go away, not the cost, and we'll talk about that later. You've got to basically fill that idle capacity that's freed up with profitable business. So what are we saying here? The CFO must now help sales and marketing to better target customers. In the past, the spending budget for sales and marketing is critical, but it should be treated as a preciously scarce resource to be aimed at generating the highest long-term profits for shareholders. This means answering questions like, which type of customer is attractive to newly acquire, to retain, to grow, or to win back, and which types are not? And then an even more tricky question, which the accounting department really needs to help out, is for the profitable customers, how much should we optimally spend attracting, retaining, or growing or recovering each customer segment? And the reason I have optimally in italics is it is an optimization problem. Why? Because you can overspend on customers way beyond what was needed to keep them, and therefore destroy shareholder wealth. But in contrast, you can underspend on marginally loyal customers and risk their defection to a competitor. So it's an optimization problem. The accountants need to basically help out the teams with what should be the level of price discounts, the level of coupons, deals, and so forth. Now let's go to that predictive view. We've left the historical view behind. The budget process is broken. The budget is typically a fiscal exercise done by accountants that has two problems. It's disconnected from the executive team strategy. It's typically not based on future driver volumes. And how do most organizations do the annual budget? They give out these cost center spreadsheets to every manager, January, December, detailed line item of the expense accounts. People fill them out. Then they submit them to someone in the accounting department who has to consolidate all those spreadsheets. And then you eventually give them to the executives. What happens when the executives see it? Oh, not good enough. That's too low. Tweak the number, send it back down, and people change some of the numbers, make it a little more profitable, give it to the accounting department, give it back to the executives. They get it. Oh, pretty good, not good enough. Up, down, up, down, up, down. This is ridiculous. We don't want to basically keep doing this stuff with spreadsheets. One, it's not volume sensitive. And there's other issues with the budget. It's out of date in a couple of months anyway. It caves into the loudest voice and strongest muscle of those patters. And another issue is when a manager is several months away from the end of the year and they've not spent all of their budget, I call it spreadsheet budgeting. What do? They start spending needlessly, foolishly. Why? Because they know that next year's budget will be basically a baseline from the past year's budget. We call it use it or lose it spending. So what's a better way to basically get an annual budget? It has to do with this diagram. There are two river streams that basically lead to the capacity and spending that you need. The upper river stream is the recurring and repeatable work. That's the operational. That's basically demand driven. The bottom one is the non-recurring work, which is project driven. Let's drill into this. For the demand-driven, the recurring and repeatable work, the solution, and then I'll get to the non-recurring. For the repeatable work, the solution is calculate your ABC model from past period backwards. Now calculate it from bottom to top. You get those unit level consumption rates, which are a byproduct of the historical view, multiply them times the volume and mix of the forecast of the sales to solve for the level of headcount and spend. You know, I'm an industrial engineer. I think it was second semester freshman year at Cornell. Volume and mix times unit level rates equals capacity required. This is engineering. For the non-repeatable work, there are 3 types of projects to go to. Those of you who are familiar with the strategy map and balance scorecard, Kaplan and Norton, know that you start with getting strategic objectives in the 4 perspectives. For all of those objectives, you then identify what are the projects or initiatives to accomplish them. Well, we fund those. That way, now we've connected the strategy to the budget, which is not in those cost center spreadsheets. There's another aspect, enterprise risk management. Increasingly, the enterprise risk management community is using a technique where they identify the probability of a risk event occurring and the impact. And for the large ones that have big impact and high probability, you do risk mitigation. So we have to spend money on that. And then the third one is capital budgeting, which everyone's familiar with. So if we basically bring these river streams together, we're going to have a good number. Now, I've decomposed it. I will go through this quickly. I know it looks complex, but have your eyes go to the bottom right box, which says derived budget and rolling financial forecast. Notice what's coming into it. From the top is the operational budget. From the left are the 3 projects: capital budget, strategy budget, risk budget. Let's start with the top very quickly. If you've got a good management accounting system using activity-based costing principles, you'll get the unit level consumption rates. Notice from the left, the forecast comes in, volume and mix, gives you the capacity plan, hours, pounds, kilograms, euros, I don't care what the currency is, then we monetize it. From the left, we get the strategy budget from the strategy scorecard, balance scorecard, we get the risk budget from the enterprise risk management people, capital budget. That number is a much better number than all of the rest. Why? Because the only independent variable is the forecast. All the other variables in this diagram basically have been calibrated. So again, costing is modeling. Now, because the budget is out of date so quickly, you want to refresh the budget at frequent intervals. Well, if you've got the ABC system and all of this other stuff in place, then you can recalculate by just changing the budget. And here's the idea with the budget. Most budgets are become less accurate one day, 1 week, one month afterwards. So if we refresh the budget at, let's say, quarterly or monthly intervals, we can recalculate that previous diagram and get ready for this, the accountants listening, a pro forma income statement and balance sheet. And once you've got those 2, you lead to cash flow statements. And that's what's so critical, especially to small businesses and the treasury function. Are we going to need to borrow in the future because we have deficit cash flow, or are we going to have excess cash that we can invest? This is where we go. Now, it is trickier when we go to the predictive view. For the historical view, quite frankly, activity-based costing is a craft. I have it, again, with the rapid prototyping, I can easily, and the Sixtina people can, and any consultants involved with Sixtina or yourselves can easily build an ABC model. But when we go to the predictive view, things get trickier because we have to classify the resources as sunk, fixed, step fixed, or variable. And that classification depends on the planning horizon, because in the very near term, a capacity is not easily adjustable. You're not going to fire employees on Tuesday because there's not enough workload in the house, hire them back on Wednesday. You carry them for Tuesday and you incur some idle capacity. But as the planning horizon goes out, weeks, months, years, you can replace full-time employees with temporary ones. You can lease assets that you normally would have bought. So really, management accounting becomes managerial economics. And this marginal incremental expense analysis is so useful for what-if scenarios, for make versus buy decisions. So we really need to get more sophisticated. So let me begin to sort of sum up. What's really happening here is the return on investment for any organization is shifting from tangible assets to intangible assets. So what I mean by that is the shift is from ROI, return on investment, from buying trucks or machines or computers or software to, which are tangible assets, to an intangible asset like information. And what this diagram is showing is the return on investment from information increases exponentially as you go left to right, from data to information to knowledge to insights to decisions. The problem is this: most organizations, and maybe those of you who are listening to me now, are stuck in the first two red bubbles on the left. All you have is raw data and standard reports. You may have bought an ERP system. That's great for transactions, but it's just basically standard reports. In some cases, the third red bubble means your IT manager, your chief information officer may give some of your managers and your analysts some what we call drill down software. Popular vendors are like Click or Tableau, often called OLAP, online analytical processing. And they can drill down to a line item of an invoice or a purchase order and see more when they see some outliers or variances from the standard reports. Performance management, which is a much broader topic, which is what I talk about, but which includes strategy maps, balanced scorecard, lean management, Six Sigma. If you're interested, go to my website, which is at the bottom left, Cokins.com. And there are a lot of free downloadable articles about performance management, but let's just stick with activity-based costing here. It begins with the first blue bubble, descriptive modeling. As I mentioned, activity-based costing is modeling. In the red bubbles, all you can answer is what happened. But once we get into the first blue bubble, we can now answer not only what happened, but why did it happen? Because we've got cause and effect relationships. Now when we move to the predictive view, the fifth bubble to the right, which is the second blue one, now we move to the predictive view. The future is coming at us, forecast, sales volume, mix, and the like. Now, not only can we answer what happened, why did it happen, but what can happen? What are the options? What if we do scenario planning? Change the sales volume 5%, recalculate, see the sensitivity, change the percentage again. It's all about basically understanding, what can happen. And at the very top is kind of the extreme prescriptive analytics, commonly called optimization. That's Mount Everest, the tallest mountain in the world. Using techniques like linear programming, powerful, if you will, analytical methods, then not only can you answer what happened, why did it happen, what can happen, all the options, that top bubble of all the choices we could make, what are the best choice to make. So basically, this is the power of information. Activity-based costing starts in the blue bubble. It's not consolidating spreadsheets. It's not peanut butter spreading indirect costs that crazy way. It's disaggregating the processes into activities, tracing them with activity drivers. To the accountants in the room, let me just tell you what activity-based costing is: basically full absorption costing done correctly, not incorrectly. So at this point, Yvonne, do we have another question that may have come in?
Yes, hi. So we have I have several questions. I'm trying to figure out which ones we can answer. So Mario Echeverria asks, Mr. Gary, in your opinion, is the budget a good tool to set cost drivers?
First of all, cost drivers and activity drivers, there's some semantics. Cost drivers are a higher level, like a storm is a cost driver, but the activity driver we will number of repairs, things for damage from the storm. But the activity drivers really can be established historically, last month, last quarter. However, when I do rapid prototyping, sometimes I will use the future budget, because their future budget, they're growing so fast or things are changing so quickly that it's just a better set of numbers. The simple answer is it really doesn't matter whether you use last year's actuals or next year's future. You're still looking at what's the head count, what's the salary, what's the percentage to the activities, what's the drivers, and identifying the drivers is a simple rule. Let's say the driver is, let's say the activity in your accounting department is process invoices. Well, what would make that cost significantly increase or decrease? Number of invoices. So to identify the activity driver is usually straightforward. Now you basically find the data, number of invoices by which types of customers or which customer, and that becomes that lower stage with the activity driver. So I hope that simply answered the question.
Yes, we have another. Elizabeth says, can ABC and conventional accounting work together?
Can ABC and conventional, it really depends on the semantics here. I'm going to interpret conventional as traditional accounting at the higher level. And I don't want to go back to remember my taxonomy slide with the three kingdoms of, I'm not going to go to it, but I'm just describing it visually just to refresh your memory. There were three kingdoms at the top. There was tax accounting, financial accounting, and management accounting. On the financial accounting, you don't have to use ABC. It'd be nice if you did, but it's relatively simple to allocate, let's say you're a manufacturer, indirect expenses overhead based on, machine hours or labor hours or what have you. Yes, it's going to be overcosting and undercosting simultaneously, but at least it reconciles in total for the audit. So when Ernst & Young or Price Waterhouse or Deloitte or whoever comes in, they can say, yep, it's these numbers are good. That's the conventional or traditional. ABC is needed for management accounting because now things are different. And it's true, when you put an ABC model, you're going to calculate product costs. They're going to be different than what was in the external reporting. And sometimes CFOs get bothered. Oh no, we can't do that because they're going to confuse all our managers. Which cost is the right cost? Well, there's no question. I had an experience with a very large food manufacturer in the West Coast of the United States. When we put in the ABC system, the CFO put out a one-page letter to everybody that said, as of today with the ABC system, the only people that will use the financial accounting will be the people at headquarters. Everybody else must use the ABC system because that's where the accuracy is. So that's a little bit of a description of it. I wonder should we go on? Yeah, let's continue. So I can end in time, because this is my favorite part of the presentation. I am so frustrated. Why is it taking so long? I have to adopt ABC. I have done some what are called CPE webinars for continuing professional education for training companies where you have to do polling questions. And one of the polling questions, I asked the organization, how are you doing your cost accounting for your company? And the first two are, direct material, direct labor, spreading the overhead. The third of the four options is we're actually disaggregating the pools into multiple pools and tracing them using ABC principles for product costing. And the fourth button is doing all the way customer profitability. So I think I had like 300 people attend. They all clicked the radio buttons. In comes the histograms. 96% were in the first two categories. 96% still spreading overhead. I said to them, I don't know if I should laugh or cry. Kaplan defined ABC in the 1970s, and you're still doing it the old way. You're misleading your managers. So why is the adoption rate for profitability using ABC so slow? Well, there's a few reasons. One, there are some technical barriers. You've got dirty data, low quality information, or sometimes disparate data sources. So you've got, Dell equipment, HP equipment, IBM equipment, and the like. But the IT department increasingly is using tools like extraction, transform, and load. It's called ETL. They can cleanse the data to come in to higher quality. That's the raw data. And they'll solve the data source problem. The next one barrier is the perception barriers of excess complexity and affordability. I described that earlier when I mentioned that a lot of people believe, oh, it's too complicated. Everyone needs to fill out a timesheet. IT will have to figure out drivers. All of those reasons I gave you earlier. Those are nonsense. The rapid prototyping technique really basically removes all of those misconceptions. The model is built so quickly in just a few weeks by the second or third iteration. And this is what Sixtina offers. Sixtina is a software vendor. I hope I'm saying this correctly, Yvonne. But basically they're providing this flexible calculation engine to make it possible. You can't do ABC in Excel. You hit the wall, columns to rows. It's just not possible to do. Plus, you don't see any of the visibility of all of the drivers and all of the so forth, and you don't get the accuracy. But here's the real problem. It's organizational behavior barriers, which involve resistance to change, culture, and leadership. To be more specific, you've got resistance to change, which is human nature. People like the status quo. They don't like change. Maybe babies like change with diapers, but not rest of the people. There's fear of knowing the truth, or other departments knowing the truth. Maybe a product manager with a profitable product doesn't want the ABC to come in and say, oh, it was really more work for your product. It's less profitable than another product manager. They don't want that to know. They don't want to be measured. They don't want to be held accountable. Maybe weak leadership. Not every leadership team basically, is the greatest. They may like, oh, I don't understand ABC, or I don't want to do it, or maybe, oh, well, we're profitable. So some of the issues have nothing to do with technology. They are all behavioral. In fact, let me just go through a list, and then we'll do the final Q&A of some of the excuses that prevent organizations from being progressive. Here they are. We are profitable. So why does it matter to do this sophisticated thing? We will purchase software. That will fix our problems. We already know our true costs from our general ledger financial reporting system. No way. That's just expenses, not costs. We have done it this way forever. We don't do that here. We already know everything. It's in our heads. Yeah, intuition and gut feel. You need fact-based information. We are a small organization. We'll worry about better methods when we get larger. Well, guess what? You may not get larger if you don't really understand your profit margins. You could be selling unprofitable stuff a lot and losing money, and your competitors are poaching away your profitable stuff. All this hype is just made up stuff from highly paid consultants. I love that one. No one looks at the reports I create, so there is no point generating better reports. That's sad. That's where the cost accountant hasn't got enough credibility with the line managers to be trusted. We cannot afford better software to fix our problems. Nonsense. This software is not that expensive in the big scheme of things. We are too busy doing other things. You're never too busy to get a better understanding. We don't know where to start or how to get started. The last answer, that's what rapid prototyping is. You just get started. Remember, crawl, walk, run, fly. My takeaways, my action steps: get educated, get buy-in. That's what you're doing listening to this webinar. Think of the rapid prototyping technique. Start small, think big. You need to think a little about incentives. When you read these slides, there are links there that will give you a bit more. Your success depends on how well and how fast the right intelligence gets to the right people. And yes, I have 4 covers of my books, but believe me, I'm not trying to promote my books. You don't, as an author, make that much money with royalties, believe me. And in fact, if you go to Amazon.com, typically chapter 1 is a free download. The book on the bottom right, Predictive Business Analytics, my most recent book, it's a free download. It's 15 or 20 pages, and that's my favorite chapter. I'll give you an overview. So, Yvonne, we've got just a few minutes left, and it's a professional courtesy to end exactly on time. We said 1 hour. So
That is right.
We've got 4 minutes.
Okay, let's see if we can solve this one from Freddie. Some clients claim that they need to arrange their cost structure, cost centers or pools, accounts, pools of cost, or an ABC or a cost model. What do they need to have at least to start a strategic cost model? Sorry.
I think I understood Freddie's question. First, I don't fool around much with the general ledger account definitions. Some people get really detailed down to paper clips, and thumbtacks. I leave the general ledger chart of account structure, that's the official name for it, as is. When we do rapid prototyping, in fact, even in your model, you're really going to basically take the salary and wages and benefits of the employees who start there and create a activity dictionary. So you take each of the departments and you say, well, what are the 3 or 4 significant activities that you do in verb, adjective, noun, grammar? I know many of the people listening are from South America, so I don't know how, Spanish and Portuguese, grammar works, but, verb, adjective, noun was like, process domestic invoices, process international invoices. Notice with those 3 words, those were the activities. So then the department that's processing it, we ask, well, what's the percentage of your time? Well, 30, 30, 40, 20, 20, 80. As long as it adds up to 100%, we're going to reconcile. Remember, everything normalizes to 100%. So Freddie, the real power is in the language of the activities, and you can get really kind of clever there. You could even put, kind of like low quality related problems, like, re-engineering product, or fixed damaged goods. Notice those are in the cost of quality called prevention and appraisal, internal failure or external. So you're really getting a lot of visibility. So I hope that answers the question.
Okay, great. Unfortunately, we have run out of time. I hope everyone got to learn something today about the future of business management and how to use advanced financial analytics to get the answers you need. We will close the event here. Thank you, everyone. We appreciate you being here. Make sure to visit our websites, Gary's website, and look into your inbox for the recording of the event. Thanks again, Gary, and everyone for joining us today, and we will see you next time. Take care.